Hi there, traders. This is Brad Gilbert with the FX Market Insight for the Friday, the 5th of March. Right, as we come into the Asian session, it's really kicking off and lining up quite nicely. So Fed Chairman Powell's come out and pledges patience, sees easy policy appropriate, which tells me he's not really worried about the increase in bond yields. So at some stage that will come into play, but the market has really run with this, and it's the key news across the board. I wouldn't worry about a lot of the other crap that's going around. And what that's done for us is given us really clear direction. Now, the market profile is a massive risk off situation. Equity markets getting hit, dollar block going down, and the dollar rallying pretty much across the board. But that's not where the activity is coming from. It's the bond markets, right? These, especially the 10-year, keep an eye on the 10-year, it's edging up every day. And the fact that it's slowly going up now, this is a fundamental shift in the market, and the market is very comfortable with it. It doesn't spell good signs for the equity markets, because higher bond yields means lower equity markets, lower dollar block, higher US dollar, right? This is probably the best trading conditions we've seen in a long time. So you need to get your head around this. If you're not comfortable with it, understand what's going on, what the driving force is, and where things come into play, because this is going to be particularly important today, obviously, with the US non-farm payrolls, right? If I can just get the right data up. This is key, right? Massive data. Fed Chairman Powell is talking about maximum employment. Now, we need to sort of see what's going on here to see, like the non-farm payrolls are a big part of the problem at the moment with the pandemic and everything else, getting everyone back into full employment, getting the economy fully going, if I can slow down. Retail sales, everything sort of connects with this. So it's going to be rather important to what's going on. Now, let me just come over here to the charts. And this is where what the action on the equity markets, right, getting hit primarily from the increase in yields in the treasuries, the dollar block going down, right? The dollar going up, okay, very clear as day on these pairs. Now, dollar CAD, look at the crazy price action here. It's primarily because oil is rallying, which puts downward pressure on dollar CAD. But then we've got the yields, bond yields, putting upward pressure on the dollar, right? So dollar CAD, it's often the one that gets caught up and pulled between two things. That's what's happening at the moment. So I'm not really looking at dollar CAD too closely. Everything else looks really, really comfortable, particularly euro. Now, I think there was something about UK budget proposal, some really positive information on the UK budget proposal that pushed sterling up to 140 quickly. And then once Powell started talking, it just rocked straight down 130 points to the downside. Same with the Aussie, right? Aussie, Kiwi, and Euro, the charts, except for that little blip higher in sterling, these charts, okay, Euro, sterling, Aussie, Kiwi are pretty much identical. And if you flipped over the dollar index and dollar Swiss, you'd pretty much have the same. And the dollar yen's just been cruising topside. So with dollar yen going up, there's no situation, there's no concern about anything at the moment, right? The yen safe haven trade is well off track. And when that's pushed aside, dollar yen becomes the dollar proxy. So dollar's going up. We've got great market conditions. We've got technical levels across the board. And we now have the biggest kicker in the market, the non-farm payroll. So we've got plenty to play for. This is where you really need to focus and start coming back to, or this is where your understanding of the market and the conditions really comes into play. And if you've been patient, right, really patient and waited for these opportunities to build, then you'll have lots of capital to throw into this. Like the markets are really invigorated because the fundamentals, okay, the data, the news, the treasury bonds, all these things are starting to work in our favor to give us clear direction. So if treasury yields keep going up, there's going to be a bit of a bloodbath on the equity markets. The dollar's going to rally through the roof and the dollar block will get hammered, right? The writing's on the wall. Hopefully the non-farm payrolls fits in. What I'd love to see is, some really positive US numbers here, and we see the US dollar rally. Well, I tell you what, that'll be the nicest trading situation we've had in at least 12 months. So make sure you check into your charts. Now, you know, you can tell from the vibe of my voice, I'm pretty excited about the situation. Don't let that dominate and you go into a trade with 10 times the capital you normally do, because you can get run over here. Understand there's about 6 different variables with the non-farm payrolls, right? So don't get yourself all bent out of shape and carried away. And actually, there's 2 lines of thought. Powell is talking about they want to see maximum employment. They want to see average earnings up, unemployment rate down, and the non-farm payroll number sort of exploding as well. Now, if these numbers are weak, the non-farm payrolls are weak, we may still see like that's going to fit in with the Treasury yields being allowed to continue to increase. That still sits with a strong dollar, right? So I was just sort of having a look at a few different things. If we get really crazy positive non-farm payroll numbers, well then, you know, it should run into a strong dollar. But what we could see is it's coming back towards where the Fed may start curving that the increase in yields, bond yields. So it's a bit of a catch-22 here with what happens with the weak non-farm payrolls. Does the dollar just continue higher as it is? You'd probably have to think so. And exceptionally strong non-farm payrolls may push things back in the Fed's face, and because they've said, you know, we want to see maximum employment, we're going to keep everything on hold for an extended period of time, et cetera, that could change things. But I can't see the non-farm payrolls like coming out particularly crazy good, right? There's so many things. The US economy is only really starting to get going. So anyway, be careful around the non-farm payrolls. It is not I know a lot of people out there and in newsland say you got to get aggressive with this and trade it aggressively. This is where you have big dents in your capital. It's best to watch the numbers come out, see what the impact is on equity markets and also the Treasury bonds. That's where the direction is going to be. This number will impact the Treasuries. Keep an eye on the 10-year. That seems to be a major focus. Whatever happens here will get translated into equities, and that comes down into the currencies, right? Follow the trail of the data, most importantly. All right, guys, pretty exciting. Non-farm payrolls are always exciting, but just be aware it's not the the pleasure ride you're probably looking for. You need to know what you're doing. Otherwise, you can have losses even though you get the direction right. All the best, guys. Cheerio. Good luck.